Hi, my name is Philip Wynn, and today I'll be talking about sensitivity analysis. So, as a quick overview, we're going to cover these topics: the goals and function of financial management, sensitivity analysis, and integrating risk into capital budgeting for projects. The goal of financial management is to make decisions that maximize the long term value of the firm and also generate wealth for its owners and shareholders. These are the major functions we'll talk about, which include investment decisions, financing decisions, and risk management. So, the first major function we're going to talk about is ensuring profitability through capital budgeting. It includes developing a plan on how money is to be invested to grow a business. It is simply investing in projects that produce more than they cost and effectively budgeting those out and planning those projects out. Second function is capital structure. It's ensuring that we have a good mix of debt and equity to fund its assets. It's aiming to obtain the lowest weighted average cost of capital while also managing the risk associated with having debt. Third function we'll cover is risk management. This also plays a role in the previous two functions, but as a function itself, it's important to understand the risk associated with certain decisions, whether that's taking on more debt or taking on certain projects. So we're going to cover what is sensitivity analysis. So according to Dahlquist and Knight, it's the analysis of the sensitivity of an input variable or output variable, sorry, to change in an input variable. It helps you calculate the importance of a variable and the impacts it can have on project outcomes. Project outcomes are NPV, IRR, or paybacks. It allows you to identify the variables that essentially have the biggest impacts and test how it affects the end outcomes. Some examples include testing to see what happens if our cost of goods sold were to increase by 10% or our sales were to decrease by 10%. Conducting this analysis ensures that the company is making informed decisions and knows the best case, base case, and worst case scenarios, and also can be utilized as a comparison tool. It's just seeing how different projects can be affected by different factors. When it comes to quantitative steps in sensitivity analysis, the first thing we need to do is set up a base case using what's our expected cash flows and assumptions about a certain project. Once we have a starting point, we can conduct our analysis by choosing a variable that would affect some of our cash flow and adjust it in small increments. So some of the variables include our sales volume, our cost of goods sold, product pricing, or just other fixed costs related to the project. And a good example would be what happens if our cost of goods sold increased by 10%? How would that affect our end outcome? Another one would be decreasing the product pricing by 10% and then recalculating our end outcome. So at the end of the day, we can compare how much each variable affects the end outcome and then rank them based on impacts. The highest ranked variables are the ones that we should focus on since the smallest bits of changes can provide the largest amount of impact. Qualitative side is focusing on the quality of the assumptions we made to set up our base case. For example, are our variables factual or are they just vague assumptions? Making these vague guesses or assumptions on certain variables may or may not have large effects. So by doing this, we can hopefully identify which assumptions carry the most uncertainty and highlight those incorrect assumptions and see how they affect outcomes. So when it comes to integrating risk using some internal methods in projects and capital budgeting, um, most of these rely on our own projections, data, and assumptions. The first thing we're going to analyze is probability and volatility. According to Lemos, the higher the volatility, the riskier the security. So higher the volatility, more or the larger the deviations can occur. And the probability is how often are these deviations likely to occur. Higher probability equals more likely to occur, which can introduce even more risk into a project. Our second point that we're going to look at is the sensitivity and scenario analysis, mainly aiming to identify the key variables in a project that are within our control. Risk arises when things that we are unsure of or uncertain of um, appear, because those can also cause substantial changes in an outcome of a project. And uncertainty is essentially just we are unable to confidently predict or assume a certain variable. Some external methods include assessing market expectations and industry data. Assessing the market for its volatility can show how much risk is present in that current market. Is the market fluctuating up and down from what is expected, or is it staying a pretty consistent line? We can also use this to examine the types of projects that we should or should not do, whether that's expanding into certain markets or introducing a new product into our current market. Using also the capital asset pricing model to determine the required return based on market risk is also critically important. Um, some examples of using this would be starting a new product in a market that's already oversaturated might introduce some higher risk that we do not want to take on. Some all the other factors we'll also want to consider is what's the expected inflation and interest rates currently in the economy, because those can also affect how our end outcomes look. Another thing we can do is comparing ourselves to other competitors within the industry and looking at the similar projects that they are taking on to see essentially how are their projects going. Comparing also our capital structure and WACC can also provide some more useful insights. So to wrap everything up, we covered sensitivity analysis, the tools used to make capital budgeting decisions, and to kind of wrap it all up again, sensitivity analysis to focus on the factors that introduce the most risk in a project. So we can utilize those internal and external methods to assess the risk in a project that we talked about and hopefully make the correct decisions needed to ensure proper capital budgeting. Additionally, determine how big those risks are and how often they can occur is important also. Um, this concludes our talk, and these are my references.